What's happening with mortgage rates in New Zealand? The global economy is changing rapidly, with several major factors hitting at all once. US tariff, inflation, Reserve Bank OCR announcements, and more. For a lot of people, it's getting hard to make sense, especially when it comes to mortgage interest rates. People are asking, should I fix my rates now? For how long? Are rates going up or down? So in today's update, I will walk you through where things currently stand and what could be coming next, so you can make more informed decisions. Hi, I'm Connie, mortgage advisor and founder of Prosperity Finance. We have been in New Zealand mortgage industry for over 12 years, and over these years, we've helped over 1,000 families navigate interest rates and tailor strategy that fit their specific needs. Just a quick disclaimer. The content I'm going to share with you today are general information and doesn't constitute personal financial advice. Please speak with a licensed mortgage advisor before making any decision. So where do mortgage interest rates stand right now? As of the April 16th, here's what we're seeing the best rates from major banks. 6 months, 5.49, 1 year, 4.99, 18 months, 4.95, 2-year rates, 4.99. The official cash rate OCR was cut by 25 basis points on April the 9th, bringing it down to 3.5. Initially, most banks only adjust their floating rates, while fixed rates remain unchanged. However, a week later, most major banks have lowered their short-term fixed rates. New Zealand has been in a rate-cutting cycle, but recently, a major global event added more uncertainty to the picture. The US announced tariffs on several countries, including New Zealand. This event sparked global concerns about economic slowdown and market instability. Now, because the New Zealand economy heavily relies on export, a hit to export revenue can affect employment, business investment, and overall economic growth. In such situation, the Reserve Bank would likely continue cutting rates to stimulate the economy. Meanwhile, the US is also facing recession forecast, and markets have responded strongly. One key indicator, the swap rates, which heavily influence fixed mortgage rates, have dropped significantly in the recent days. Hence why banks start dropping their fixed-term interest rates. So why did the swap rates fall sharply? There are several reasons affecting these rates. Global economic slowdown is now widely expected. The latest New Zealand business survey also shows only 2% of New Zealand businesses expect to raise their price in the next 3 months, the lowest in decades. And on the other hand, the US tariff are increasing import costs, squeezing margin for New Zealand companies and tightening cash flow. So while short-term inflation looks low, medium to long-term inflation risk remains, and the Reserve Bank will need to keep monitor that balance. So what should we do as a borrower? There's no one-size-fits-all answer, but here are some general ideas based on different situations. If your loan is not too large and you are comfortable with some rates movement, then 1-year fixed rates could be a good option. It offers flexibility and there's still room for further cuts. If you prefer more certainty and stability, especially if you have a large mortgage, 2-year fixed rate may be a safer bet. You can also consider a split strategy, fixed part for 1 year and part for 2 years to balance risk and flexibility. So in summary, right now is a very tricky time for interest rate decisions, unfortunately. On one hand, the global economy is still uncertain and the US-China trade tensions are still evolving. And on the other hand, swap rates are falling and Reserve Bank may well continue cutting the OCR. So that means fixed mortgage rates are likely to continue trending downwards. If you're not sure which rate structure is the best for you, feel free to get in touch with me or my team. We will provide tailored advice to help you make informed decisions. If you find this update helpful, don't forget to like, subscribe, or share with someone that might benefit. Thank you for watching, and I'll see you next time.